Let's move on to our next top story. We have a Technology Brothers exclusive where for the first time in Technology Brothers history, we're covering an Eric Newcomer exclusive on General Catalyst's fundraising. And so we have slides here from Eric Newcomer showing how General Catalyst has performed, how they've scaled, and Eric Newcomer has the firm's Q3 2023 fundraising documents. And General Catalyst is on a tear. They are just going big. Ultimate size lords. Let's hit the size gong a couple times for them. They're just
and they
massive.
even, I don't think this article would have caught it, but they came out yesterday announcing they have a new fund of funds platform to fund other emerging managers. So they're just going, we love when people get aggressive, and they are certainly doing that.
Yeah. I mean, the narrative around General Catalyst has been, it was a VC firm, then it was a growth stage firm, then it was a private equity firm. Now it's just an asset manager in every sense of the word. I think they also launched a wealth management product, right?
Yeah.
Did you see that? Yeah. And so they have a hospital, consumer value financing, a wealth manager under the leadership of CEO Hemant Taneja. The firm has grand ambitions. Newcomer got his hands on documents that show how General Catalyst has presented itself to prospective investors. The documents he obtained are admittedly a little dated from 2023. That's a bit old, Newcomer. Got to step it up. Got to be hanging out at the Sandhill Rosewood a little bit more.
Yeah, or the Nobu,
Nobu, hanging out.
I want to see a tech journalist go to Japan, study how to make sushi for 10 years, and then go get a job at Nobu and just sit at the sushi bar. You're just making sushi. Everybody thinks you're just, making a nice hand roll. Turns out you're listening for scoops. You're picking up every single thing that they say. You're yelling "Arashimase," but then you got your ears, both ears here, because you got a bunch of allocators right in front of you. Yep. You're picking up this round's happening, that round's happening. Maybe a faster way to do that would just be to go pay off the individual, the wait staff, the sushi chefs, etc. But there's alpha everywhere, folks. Yeah. And there's certainly alpha in the Palo Alto Nobu.
Yeah, Newcomer, become a janitor at Amman, and then just go around and just sweep up all the slide decks that are laying around the pool and the jacuzzi and the spa, and just scan them, throw them up on the newsletter. You're going to triple subscriptions. You're going to be printing 5 million next year in EBITDA. You're playing small ball right now.
Yeah.
Yeah. And so the investment memo provides a detailed look at General Catalyst's strategy and performance as it was raising its last suite of venture funds. And so let's go through some of these. They are absolute dogs, General Catalyst. Billions raised in October 2024. The firm announced $8 billion of new funds for its Fund 12. Been around for a long time, including $4.5 billion for the firm's core VC funds, $1.5 billion for its creation strategy, and $2 billion for separately managed accounts.
$1.5 billion for, I'm reading that as incubations. Is that correct?
I think so.
$1.5 billion for incubations is insane. That's just an insane number. Given how capital efficient incubations can be, because sometimes a firm will put a founder as an EIR, so they have a bit of an income and benefits while they figure out what to build. I have no idea how it's actually structured, but
their latest incubation was a roll-up, and so they wound up buying a lot of existing firms. And so you could imagine if you're buying like a mid-sized business, dropping AI on top of it, it's going to be $100 million equity check and then a couple $100 million in debt, maybe. That's going to go pretty quickly. That's 15 deals if you're doing $100 million checks to kick off these like incubation roll-up type things. I have no idea how they're sizing their bets, but I'm sure we'll find out more. Let's go to the evolution in the year 2000. The firm started in Boston, founded by serial entrepreneurs David Falco and Joel Cutter during the dot-com bubble. General Catalyst established credibility. Let's see. They hatched winning companies, resulting in Kayak, Demandware, and Virtu. Fund 5 in 2007 was $722 million, already pretty big. During the global financial crisis, they expanded to Silicon Valley in 2010 and New York in 2012. They did a fund 6 of $500 million. Fund 7 was $676 million. Every fund is just getting bigger and bigger. Ken Chenault, who I've actually interviewed, ramp investor, former CEO of Amex, he joins as the chairman. And then in 2018, General Catalyst solidifies a full stack platform by raising multiple funds segmented by stage. This is the Fund 10 group. Fund 10 comes in at $2.9 billion. General Catalyst raises its first sector-specific fund, the Health Assurance Fund. Hamant becomes CEO. They open a London office in 2021 post-COVID, and Fund 11 clocks in at $5.4 billion, baby. And so there's a little bit of a breakdown here for Fund 12. They have their creation fund, which hatches companies, transforming companies with a catalyst advisor and executing venture buyouts.
Okay, so that's interesting. So it's their creation fund, but it's a venture buyout.
Yep.
Strategy. So that makes
and they're trying
sense.
to own 25% of the business when they do
trying to deploy $1.5 billion when you're creating, pre-seed companies, and presumably making room for other investors too.
Yep. Impossible.
Difficult.
But they're going to buy they're going to buy companies like they're a private equity firm, but where they think there is VC like opportunity and venture scale. And so they have the Ignition Fund. This is where they do their core early stage work. Another $1.5 billion there. They focus on seed, Series A, Series B. And of course, they focus in 10 to 25% ownership target there. They have their Health Assurance Fund, which is targeted at digital transformation of the healthcare industry. $750 million. Early stage seed, Series A, Series B in healthcare, 10 to 25% ownership targets. And then they have their Endurance Fund. That's their growth and later stage investments, $2.25 billion. And this is all out of Fund 12. And so they've taken this full stack approach. You can look at some of their leadership here. They focus on basically everything: healthcare, fintech, global resilience, technology, consumer, and enterprise. And we can go through more of the slides, but you might just want to subscribe to Newcomer. The guy gets scoops, even if they're a year and a half old.
It's always scooping.
Always scooping.
Yeah, an absolute dog.
Is there anything else we should talk about with regard to General Catalyst? We got some boys over there, some absolute dogs, writing huge checks, making plays. Love to see them on the timeline.
Every time a venture fund comes out and announces multiple $1 billion of new AUM, there's always naysayers, haters saying, "Oh, this is not real venture capital," or how are you going to actually put up returns like this? But you have to just give people a little bit of credit. If somebody's raising $8 billion, unless they're Masa Son, they have probably planned things out pretty precisely. They probably have a very coherent strategy, because that kind of money doesn't change hands and get invested without, the people that are investing those dollars are sophisticated, and they're taking a portfolio approach. They don't need every fund they invest in to outperform, but got to give credit. And I like to see that General Catalyst is getting aggressive and evolving venture. It's not a cottage industry anymore. I think that the super, super early stage stuff will continue to be somewhat boutique, and there's always going to be opportunities for new managers. But, the bifurcation of venture from these sort of small $10 to $50 million funds all the way to these like $5 to $20 billion funds, or $5 to $10 billion funds, that is seemingly the new normal. And I think it's overall healthy. It's important for early stage investors to know that, if I invest in a company at a $5 to $10 million valuation, that if they do well, there's going to be, $50 billion of downstream capital that somebody like a GC or an Andreessen or a founders fund or a Sequoia can deploy into that. So overall, I think it's healthy. I think there's going to be it's going to be cool to see the generation of investors, allocators that come out of firms like General Catalyst that were there during the transformation and then can continue to innovate down the road. So overall, very cool. And, look, they're probably doing a few 100 million ARR just on the fee side.
Yeah.
Uh,
So the
which,
the old model of 2 and 20 is gone. VC firms used to take 2% annual management fees and 20% carry, but not a general catalyst, baby. The firm's share of profits on investments starts at 25% and climbs to 30% if the profits are above 133% in aggregate contributions. And so a lot of these different funds have different management fee structures. The creation fund gets 2.5% management fee. The ignition fund gets 2.25. Endurance is their growth fund, so a little bit lower, 1.75% management fee. And the health assurance fund gets 2.5% management fees. So Eric Newcomer clocks it at $120 million a year just from Fund 12. And remember, they're raising these new funds every couple of years. And so that's going to fund a lot of employees, a lot of office space, and a lot of ski trips to Tahoe and Sun Valley.
Yeah, and one thing to note, yesterday, we will probably talk about this later in the show, but yesterday some news broke, I think from Bloomberg, that Trump was exploring eliminating what has been called the carried interest tax loophole.
Yep.
And I think that loophole is a sort of not the best way to characterize it, because what they're referring to is the fact that investors that are, people that manage and deploy money that's not necessarily their own, they get, when they, if you have a $10 million fund and it does well and you're in carry, that carry gets, has historically been treated and today gets treated as capital gains. What they're trying to do is make it treated more like ordinary income. So instead of paying a, 15, 20-ish% tax rate, whatever it is, you might be paying closer to 50% tax rate on that. And so for someone like GC, who's deploying billions of dollars and presumably wants to make a great return on that, that's billions of dollars that they would be giving to the federal government or the state government, depending, on their performance. So would be pretty brutal for the industry in many ways, but it's coming from somebody like Trump, who runs his own money. So as a real estate guy, he's using his money. I'm sure he has co-investors and using a lot of debt, but to him, it maybe is not so important how carried interest is treated. But if you're a fund manager raising billions, or if you're a fund manager that's raising 10 million and really making money on the carry piece versus the fee side, would be pretty devastating. So
yeah, the carried interest loophole closure, this whole discussion that came up during the last administration, didn't go anywhere. You said that if it goes through, VCs will make January 6th look like a baby shower. I think we can see lots of VC and private equity associates protesting on the National Mall if this happens. Yeah. It'd be very bad for the industry. And who else said something interesting? I forget who it was. Dan Primack. Dan Primack says a source on the phone just now on the carried interest tax situation is like the Red Wedding. Trump collected all the VCs at the White House so he could more easily murder them. And so
to be clear, it's not going to be the end of the world, but it does meaningfully impact. When I look at it as like, from time to time, I'll do an SPV into a company that I'm excited about, and now I have to, if they do change the law and the tax treatment right now, if I invest, $1 million via an SPV, I take 20% carry on it. Maybe there's other partners in the deal, so I'm not actually getting the full 20% carry. After it's taxed 50%, it might not have even been worth my time to do the deal. I might have been better off just putting in, 50 grand myself, letting it ride, and knowing that it's going to be treated like, because putting together money like that via an SPV, it's a lot of work. It's super time intensive. And so, you're basically looking at the way that I've always looked at it is you're investing in the deal with your time. And so from that lens, it's saying, okay, maybe it should be treated like ordinary income. But the payoff is so unclear and it takes so long to see a payout, and you only see a payout if, there's a meaningful return. And so I see a good argument to keep it as is. I don't think it should be framed as a loophole, but
Sure.
we'll see how it plays out.
And so Manifold Markets, I don't know how up to date this is, but they are running a market on carried interest repeal by the end of 2026. It's at yes 40%, no 60%. I imagine that's pretty low liquidity. Meb Faber here, who actually follows me, says we need a poly market on the chances of carried interest. LOL. Close the carried interest tax deduction loophole. So everyone wants to know whether or not this will happen. It could just be one of those things where, like Trump is doing with Canada, we're going to make Canada a state, this and that. Trump loves to open with a crazy proposal and then back it off and get something in trade. And so I could imagine this saying, look, I'm going to close the carried interest loophole, blow up your entire industry. But as this gets, now that I brought everyone to the negotiating table and people realize how serious I am, Trump will say, well, actually, I'm going to close the carried interest loophole on investments that are made outside of the United States. Or, and really his goal the whole time has been, I just want VCs to invest in American companies that make products in America. And you could see that being more aligned, and that's actually what he's going for. But how does he get there? Well, he's got to come in with a hammer and get everyone waking up and saying, hey, look, it's going to be the red wedding. There's going to be a bloodbath unless you play ball. And then, he's set the bar here. And so when he backs down, he gets exactly what he wants. And so I could see that happening, and maybe that would be good for America. It's possible.
Le art of the deal.
Le art of the deal.